crypto capitulation, as a low liquidity weekend sees Bitcoin below 18K and ETH sub 1,000. The large caps underperform relative to alts as lending collateral gets dumped. Volatility and skew signal a short-term bottom may be in as call buyers come out of the shadows. All this and more in this week's Crypto Insight. So crypto this week, well, we've been calling for about an 18K to 20K target to the downside. And that was reached at the weekend. We had that capitulatory type move, which was clearly driven by liquidation, miners puking, collateral being dumped against loans and things like that, right? So, leverage being flushed out of the system, managed to get us down to below 18K. Now, I've been calling for this move as kind of a completion of that final leg lower because, that move from 50K to 25K felt like a third wave of some kind to me. And I was thinking we need a fifth. But the speed of this sell-off doesn't feel like it's, a conclusive type move, right? It feels like that was pretty dramatic, which means, again, for that move down, there needs to be some sort of fifth wave lower again, right? So I don't think, and also that lines up with the idea that the equities bottom's probably not in either, right? So whilst I do believe that we've had enough of a flush out to get some sort of bounce in the short term, because things were really, really overdone, right? And we saw extreme skew levels, extreme vol levels, right? And just blood on the street, yeah? Extreme negative sentiment, things like that. So I do think a bounce is due, but I don't think the bottom's in, basically, right? So let's just be clear about those points, yeah? Now, how long is the technical bounce? I mean, where is the technical bounce going to get exhausted? Things like that. I mean, I've done a few Fibonacci confluence grids that suggest to me that upside levels to watch are here. So, I've got them in the report, so you can have a look, but these are sort of upside targets. There's a big one at around 23K and then another big one at 24.5. I'll be very surprised if we manage to reach those upper levels at like 26 and 28.5. So I'd probably think we're gonna get a bit sticky and meet some resistance in that 23 to 24.5 zone if we do manage to rally. But to be clear, I mean, from 21, I mean, you're looking at more than 10%, right? You're looking at 10 to 15% rally from here to get up there in the first place, which is a pretty healthy bounce, right? So that's the sort of thing I'm looking at on Bitcoin. Yeah. Now, the way I'm playing that, I did pile into a few short dated at the weekend. I couldn't resist. So I piled into a few short dated calls on Bitcoin, ETH and Sol. But they're very short dated, right? They're kind of lottery ticket type trades. So, but it's one of those, I know it's a bit speculative, but things did feel pretty beaten up. So that's why I had a little stab at it, basically, right? So put a little bit of premium on the table there. Now, if we look at Ethereum, obviously that got beaten up pretty bad. It got below 1,000, reached around sort of 8. What was the lows? The lows on ETH were 879. Why has ETH been getting beaten up so badly? Well, there's a hell of a lot of DeFi staking and like collaterals for loans and things like that in the DeFi space that are denominated in ETH. Obviously, the whole Celsius thing. There was a bunch of staked ETH that they were holding that they needed to dump. And so that ratio between staked ETH and ETH is now being used as a bit of barometer for stress in the DeFi market. And that's still trading at about 0.95 as opposed to parity, which it should technically trade. The BTC ETH ratio, got down pretty close to those support levels, down at 0.048 that I'd flagged. And now it's back to the previous one at 0.055. So bouncing around, but hopefully finding an interim low there at that area and can maybe stage another. If it can stage a recovery to that area in the 0.06, then you're looking at, arguably 10% outperformance of ETH on the upside, which, to be honest, given how much it's fallen, doesn't sound like unfeasible, right? So, a Bitcoin, and then finally Bitcoin dominance, right? Bitcoin dominance has actually taken a hit because Bitcoin kind of joined the party in terms of puking. So whilst you had a big move from 41 up to 48, you've repriced that back down to 44 in terms of Bitcoin dominance, right? So quite interesting to see that in such a weak market, basically showing that really the epicenter of the pain in the last move has been the big caps, yeah, which I think is often a sign that things have kind of reached a bit of a crescendo, right? And people are dumping indiscriminately, just dumping even the safer places in the space because they kind of have to, not because they want to, basically, right? So when people are dumping it because they have to, is often a sign that you're probably near an interim sort of bottom, yeah. And then just on the bigger picture, yeah, as I already said, that staked ETH versus ETH ratio is one to watch. You've had the crypto fear and greed index got to like some pretty crazy levels. That's often a sign of short-term capitulation. But that's not to say, like I said, I don't think we've reached the ultimate bottom, but it's just, interesting to see where that is. It's pretty beaten up. And then this kind of chart that I think Bank of America put out, if you zoom out and look at a log chart since sort of Bitcoin's birth, right? And you see these cycles playing out. And this looks a lot like the chart that, what's his name? Plan B puts out, right? In terms of his stock to flow model of how to price Bitcoin, right? And I'm not saying I massively subscribe to that methodology. I'm just saying that he shows the shape of this curve, right? And you get these massive run-ups where Bitcoin goes into a bubble, and then and then you get these corrections where everyone says Bitcoin's dead, right? And it's just pretty common to get these cycles. But in the context on that log chart, I mean, this is nothing to be overly concerned about, right? So just zooming out, if you think from that perspective, now obviously not all of us were lucky enough to get into Bitcoin in 2012, right? But that was $1 back then, right? So if the fact that it's like trading at 20,000 when it used to trade at $1, I mean, to say it's dead is probably a little bit of an exaggeration, basically, right? For all the people who are now banging the drum saying, told you it was a Ponzi scheme, right? Things like that. It is notorious for leverage to be built up in this space, and leverage needs to get flushed out every now and again, right? And the macro backdrop is horrible for it. So that's what we're going through right now. But it's just another cycle, just like every other cycle. And there's nothing in this cycle to suggest that this time Bitcoin actually dies, right? So I would take some comfort from that for those who are in the space and who believe in the space. Zooming out, I don't think it looks like that big a deal, right? Over to Aaron for on-chain.
How's everyone doing? So for this week on chain, kind of similar to last week, a lot of the action happened on the weekend. So we will be without Will Commence newsletter this week as he publishes on Friday, and he kind of missed that plunge down to 17,000 or so. But focusing in on Glassnode, the kind of theme for this week, as you can see here, was them wondering, has max pain been felt? So starting on the top left, we're looking at the realized loss. Basically, that's that total value delta between coins bought at higher prices and when they were spent on chain. So you can see, over the weekend, we saw selling at levels that have not been seen historically throughout Bitcoin's life. We had 3 consecutive days of over $2.4 billion for a total of over $7 billion. Again, you can see this red spike kind of topping all other highs that we've seen. And Glassnode basically kind of deducted that this increased selling has come from basically 2 cohorts in the midst of capitulating. That is the miners and the long-term holders. So starting off with the miners here in the top right, we're looking at the Pule multiple. We looked at that maybe last week or the week before, but as a reminder, it's a ratio of the value of the block reward the miners are getting compared to the 365-day moving average of that same value, where, when you get below that 0.6 mark that Glassnode's pointed out, that's where, 40%, or the miners rather, are their income revenues 40% less than it was about a year ago. And they are laying that over this difficulty ribbon compression. So basically, real quick, the difficulty ribbon is if you took the moving averages, 90-day, 30-day, 120, 100, and mapped them out with different colors, it kind of forms a ribbon. And Willy Woo came out with this basically saying times of where that difficulty ribbon compresses seems to be good times to buy. And the reason he says that is because, kind of like Imran was alluding to, these miners, they sell their coins a lot of the time to run their operations. The stronger miners that have better balance sheets, they do less selling. The weaker miners do more selling. And so when the income revenue gets really low, like this Pew multiple is showing, basically what happens is the weaker miners that sell more, they come offline. You see that compression in the ribbon, of the difficulty ribbon. It leaves only the stronger miners there. That kind of tends to form a base for the market to pick back up, as you don't have that selling pressure. And so you have the Pew multiple in the green, and then down here you have this purple is quantifying the difficulty ribbon compression, showing that we've gotten under this 0.06 mark, which Glassnode signifies as being significant compression of the ribbon. But you will notice that we haven't quite reached the lows that we tend to see before things really pick back up. Moving to the top left, we're still using that difficulty ribbon compression and then also the Pew multiple, but they combine them to form these gold areas. So whenever we've had times where we've gotten to this green area in the Pew multiple and a difficulty ribbon compression below 0.06, that's these gold regimes. And then they overlaid that on top of the realized price for miners. You may remember realized price is just the cost basis for coins the last time they were moved on chain. And so they're basically just showing that very rarely in Bitcoin's history are we hitting this Pew multiple and difficulty ribbon compression at the same time that we're trading under the realized price for miners. Last time it happened was the COVID crash, and generally only happens there in bear markets, where it kind of tends to mark that real final capitulation of miners before things can kind of switch phases. And then lastly, we're going to look at the long-term holder MVRV. That's just the market value compared to the realized value. And it's just showing here that we've fallen below 1, basically since the first time since the COVID crash. Really only tends to happen when we're in these bear markets. We kind of looked at short-term versus long-term holder last week. Now that this long-term holder has fallen below 1, all the market participants are now below 1. That's aggregate market, short-term holder, long-term holder. Again, that really only tends to happen in deep bear market capitulations. And so right now, while we're at 0.85 for long-term holders, that means anybody who's been holding for over a year, on average, they're staring at 15% unrealized losses. This is more than the COVID crash, but not quite the bottom, the pain that we felt in 2018, 2019. So the question does remain, has max pain been felt? Only time will tell. And that is this week's Glassnode on-chain.
So, so in vol this week, I mean, obviously realize it's been insane, right? So the swings are just unbelievable. And so you can see the blue lines, Bitcoin on the left, ETH on the right. Whilst you're not quite at the peak, you're talking about a 130 realized on Bitcoin, and you're talking about a 180, 190 realized on ETH. And that's quite a big premium over where the implieds are. So whereas obviously the implieds reached their sort of pinnacle early last week with Bitcoin hitting 220 in the front end. This is 1 week vol, and ETH hitting kind of 270. They absolutely collapsed into the DOV selling as we had flagged. They kind of bottomed out, going in, actually on Thursday, they bottomed out, and then over the weekend, you notice that despite making new lows in spot, look where the vol got to, right? 1 week vol only recovered to 140 on Bitcoin, and it only recovered to 170 odd, 160, 170 on ETH, despite free falling and making new lows. So the vol market was basically saying, nah, we're done. This is not going to last, basically. And then obviously as we recovered, those vols have then gone on to make new lows, new local lows. Bitcoin back to close to 80, and ETH about 100, just over 100, right? So the gamma has been amazing. The implieds are now priced for more stability, suggesting that this crazy realized isn't going to last. Now, to be honest, I wouldn't be surprised, though, if a 10, 20% rally happens pretty quickly. And so the realized actually isn't too bad. So you may well have some good value gamma still for a few days as they kind of overshot the implieds. And we may well get some pretty high realized to the upside in a recovery, right? So I certainly wouldn't want to be too short gamma right now in crypto. I had been kind of leaning a little bit short into the weekend, and I've kind of flipped it all and brought it all back, and kind of I'm leaning a bit long now, and I'm willing to pay a little bit of decay to have some upside call action, basically, right? So that's kind of what I'm going for there. If we then look at what the term structures look like, no major surprise there. As the vol kind of normalizes, we went from extreme backwardations in the dotted blue to, you know, still in backwardation, as you should have, given the realized is so high, right? I mean, the fact that we're in this type of inversion, but realized is like 30 to 50 vols over the front is, you know, it kind of shows why you kind of have to have a bit of inversion when it's moving this much. And then that long end, you know, that long end, not really that elevated, but it's probably still got room to go down, right? Long end Ethereum is like high 90s, it looks like, and Bitcoin's kind of in the 70s. So, you know, if things do normalize, yeah, that stuff maybe got a bit of downside, but clearly heading into DOVs this week, if the market realized does come down, then that front end has easily got another 20 points of downside to make this curve much more flat, basically, right? So that's kind of what I'd be looking out for. I'm not going to try and preempt that and sell the front, because I just don't think the gamma is great to be short right now. But just kind of be aware that may well be where the implies are heading into Friday. Yeah. And then skews kind of really the other interesting one to talk about, whereas it had reached levels that I've not seen before in crypto. And I'm not sure we've ever been that extreme before. So 25 delta 1 week skew was at 70 on Bitcoin early last week, and it was at close to 90 on Ethereum. And whilst that did start to tighten, it was holding a fairly stubborn bid as people were aware of the crash risk and the liquidation risk before the weekend. So you're seeing, you know, it was parked in the 40s and 50s, both in Ethereum and Bitcoin in the short end skew. After the weekend rally, after the Sunday rally, we now see that skew completely disappear for puts. And it's, you know, it still is for puts, but we're talking about order of magnitude of like 10 vols when it had been trading 40, 50 vols and even 70 vols, right? So that repricing in such a short space of time, I mean, it's literally happened since Sunday, right? That is quite bullish. That's showing that some funds have come in and they had a go at it, basically. So, right, we want some short dated calls now, yeah? And are trying to play the upside. And then the last thing to talk about is crypto flows, option flows. So the main sort of things that I've been seeing, you know, we'd obviously on the crash down into late last week and over the weekend, we had seen rolling down of puts, very normal. You know, a lot of puts have gone in the money, short dated puts especially. You know, you want to extract that premium, you want to roll them down and maybe roll them longer, right? So you're seeing some of these rolls into lower strikes are happening. Some of them are happening in June, but some of them also happening in kind of July expiries where people are trying to add a bit of time to those puts as well, basically, right? And then, you know, you see these in the money put volumes. Those are the ones that are getting unwound, and then you're getting new fresh puts being bought in the lower strikes. And then you've got some opportunistic call buying going on, coming in as things were so damn beaten up, basically, right? And again, typical theme we've been seeing is the call buying typically comes in the longer dated maturities because people recognize that it might take a bit longer for this market to bounce. And, you know, the vol levels that you're paying up on the upside, you know, are cheaper if you go a little bit longer down the term structure, basically, right? So there's a reason to be buying longer dated calls or longer dated call spreads to express that more bullish view, right? In Ethereum, similar story. We saw, you know, a lot of pink, which is 24th of June, getting rolled into lower strikes. 1st of July expiry is the bright green. Some of them into lower June strikes as well. And then you saw this load of calls trading between 1250 and 1400 in the early July expiry. So again, pretty short date. I actually traded some of those myself. I think I traded the 1300 calls to 1st of July as a 20 delta, you know, long call option type thing to try and get some leverage. And the funny thing is, like, even though the vol's at like 100 plus, the thing's moving at close to 200, right? So if you're just trying to play a short dated 20% bounce, you kind of don't mind the idea of vol being in the hundreds because you know what this thing's capable of, basically, right? Because you're more thinking of it from a premium leverage point of view than an implied, like even if the implied vol goes from 120 to 100 and I lose money on vol, if I get a 20% rally in spot, I kind of don't care, right? Because that has more than done its job in terms of multiplying the value of that option, basically, right? So I think crypto is definitely in a place where it can have some extreme bounces, right? And then you see a bunch of call volume on the upside again, sort of in that 2,500 and above area, both in December and September, and call spreads very much in vogue again because people don't want to just pay up and buy loads of Vega in the longer dated part of the curve, which doesn't have as much gamma on it. So, you know, the way to kind of maintain leverage but not buy too much Vega is to do call spreads. And those are structures that make a lot of sense in this sort of environment. And you can see the call flow really, again, dominating like 70% of the market share versus puts, whereas in Bitcoin, it's still skewed towards puts, basically. All right, so not as much speculative call action going on in Bitcoin as there is in ETH, basically, right? Okay. All right, and that's kind of it from me on crypto.